Okay, good morning, everyone. I hope you can all see me and hear me. Okay, very pleased to be on this panel about investing in India from a real estate perspective. We're very fortunate indeed to have two um, leaders in their field, Dave Santani and Chand Chakravarti. You can see their bios on the website, but needless to say, they've got incredible local and domain expertise in this topic, and I'm particularly grateful that they've agreed to join us today. So India, as you will have observed from the media, is in the grip of its own COVID wave, which is taking up all of the headlines at the moment. You've all seen the very distressing news coverage of the way that the pandemic is raging in India. And clearly, the pandemic mindset is probably very alive with most investors and operators in India right now. Having said that, I think what we want to focus on today, obviously, is the fallout and the impact of the pandemic, but more from a longer term perspective, I think we want to examine the theme of whether investing in India in the real estate sector is still a live and interesting proposition. Historically, people look at India from a great distance. They observe that the demographics are fantastic. The median age of the population is 27. The growth rate is higher than you get in the rest of the world. Anywhere between 5 and 10%, depending on who's in power and who's in charge. But certainly aspiring to long-term growth rates in the 7 to 10% range is a good thing for India, or possible, according to many economists. So there is really this tailwind of incredible demographic economic support. However, of course, macroeconomics doesn't ever tell you anything about the difficulty or practicality of executing on the ground. India is, widely known to be a challenging destination in which to invest. Having said which, there are a whole host of players recently that have invested in India. Clearly, there has been a lot of focus on distressed money coming into India with some very experienced global distressed investors, and perhaps we can touch on that. But we're going to start by asking the panelists a very simple question, which is, once the pandemic is over and in the immediate aftermath of the pandemic, what do you think that sentiment towards India is going to be? I guess it's worth making a distinction between the immediate pandemic impact and then, the longer view of investment in India. Perhaps I can start with you, Chand, to answer that question. And obviously, as a preamble, it may be worthwhile for you to, both of you, as you start, to just introduce yourselves briefly, talk a bit about your firms and what you're doing, and then maybe discuss the pandemic and the post-pandemic scenario for investment in Indian real estate. So can I ask you to start there, Chand?
Sure, thanks, Ravi, and good morning, everyone, and thank you for the opportunity, Oxford University, for participating in this panel session. My name is Chand Chakravarti. It's a longer name, actually. If you really want to get to know me, you need to pronounce my name well. But jokes apart, I represent Ivanhoe Cambridge, which is the real estate investing arm of Caisse de Dépôt, the pension plan of the state of Quebec. Yes, far away in French Canada. We have been in India for, in spurts between 2007 and now. I joined the firm in 2018 to start Ivanhoe Cambridge 2.0. The first round or the first experience was not great, like for a lot of foreign investors in the vintage of 2005, when a lot of foreign investors came to the country with lofty expectations and I dare say misplaced expectations. I think a lot of hard lessons have been learned since. The market's changed quite dramatically since then. But I would just, say that the market is still only 20 years old as far as being an institutional marketplace is concerned. So to expect it to behave like one of the OECD markets or just the general developed markets is I think is a fool's errand. And we found that out through our own collective experiences, hard knocks, as I call it, over the last 15 odd years. But I think, it's easy to get exasperated, Ravi, with the Indian marketplace. And I make the distinction between Indian marketplace and Indian real estate. Indian real estate is even more exasperating. But and I think Indian real estate is at best, even now, an acquired taste for foreign investors. For a variety of reasons. It could be diversification. It could be, in search of that alpha, that elusive alpha, I should say. But and it's so therefore it's very easy to get despondent and not upset, but generally less than elated with the performance in the short term. But what we found is this is a marketplace where the experience and the data needs to be looked at very carefully and harvested. And so what do I mean by that? What I mean is one shouldn't just, give up and leave, because that's the worst thing you can do. This is a marketplace that you need to show patience. Like, I'm sure Dave will talk about Brookfield's own experiences. They've done extremely well. And I think, that is the broad takeaway that we've had about India. You have to stay put. You have to learn from your mistakes. You have to learn from others' mistakes and not get despondent. It's a very large marketplace. You need to pick your bets. You can't be everything to everybody. It's a very large country as is, extremely complex. The real estate landscape is even more complex because land is a state subject or a provincial subject. And so, it has its own complexities, therefore. So I can go on and on about how difficult it is to do business in India, but what we found and what we've tried to do is focus on the positives. And I think over the last 5 years, there's been a lot of change that leads us to believe that India is in that on the cusp of becoming a more formal real estate marketplace, and that gives us hope. And some of those changes that have led us to believe in that manner is, some of the reforms like the Real Estate Regulation Act, the Insolvency Code, the Unified Goods and Services Tax, and the general advent of global capital that has, forced change in a good way. By force exiting a lot of the mom and pop type operators and managers, and I think that can only be good. And I think we look at India as in blocks of 10 years. We don't look at this as a 2 or a 3 or a 4 year investment opportunity. You have to look at it in blocks of 10 years. Try and not be everything to everybody. And I think in that context, I would conclude by saying, even in the context of the pandemic, it's easy to get phased. And I'm not trying to be sermonizing out here, but I think one of the things that we've been taught is not to get overexcited about trends as they come in, or get too disappointed or phased with trends if they're not going according to what we thought when we first started following them. And so there are 2 or 3 things that we think we'd like to spend time in India because of the structural trends. Housing is obviously one of those that reams of paper have been written on it. I'm not going to spend time talking about that. But that apart, I think, apart from housing or middle income housing, I think what we have focused our energies on, like many of our peers, has been trying to see what we can do in the office segment. India, at the end of the day, whether we like it or not, is the technology hub of the developing world. That's there are lots of good stories to be told about those over the last 2 decades. And the second segment that we really like and are focusing our energies on is the light industrial logistics stroke warehousing space. And I think, pre-pandemic to post-pandemic, our ambitions remain somewhat modest as far as India is concerned. But we are extremely hopeful about how the country is going to evolve post-pandemic. And I think we've taken some limited bets. We haven't gone out there and splurged money because we genuinely think that valuations at various points have been extremely challenging. And also the complexity is not for everybody to be able to fathom. And I think for a variety of those reasons, we find ourselves where we are now hunting for new opportunities in this dislocated marketplace in the middle of this pandemic. And even as late as early last week, we made an investment in a public scrip, in an IPO, and that is to demonstrate that there is no use trying to behave like a deer in the headlights and not know what's going on, because these markets are fast changing. We've seen the global financial crisis. We've seen a bunch of domestic disruptions over the last 5 years in India. It's a market that it's not for the faint-hearted. And that's how I'll conclude my opening remarks.
That's really useful, Chan. Thank you very much. So lots to pick up on there. When I come back to you, I want to talk to you about the actual applicability of the insolvency code to the real estate sector. I understand that it's not quite fit for purpose. I don't want to spend too much time on whether offices will come back, because that is globally, because that is obviously a post-COVID theme across the world. And I believe the next panel is going to focus on that. But maybe we can pick up on logistics, which obviously is an untapped market, given that many Indians lack a credit card, and the whole thing is becoming much more organized in terms of online commerce. So perhaps we can pick up on that. I'm glad you brought up offices, because I understand that offices in India are dominated by Brookfield, from where our next speaker hails. In fact, you've got a significant portfolio. And also, interestingly, I believe that Brookfield also has a REIT in India, Dave, which is trading, I guess, at, or I haven't looked at it recently, but none of these seem to trade ever at much of a premium to their listing. So I'd like your observations on REITs. Obviously, if they take off to the degree that they've taken off in OECD markets, it would be an enormous contribution to the efficiency of capital raising in that sector. But I'm preempting what you're going to say, so let me not do that. Let me ask you to briefly introduce yourself, the scope of Brookfield's activities in India, and then perhaps if you can add to Chan's comments on offices and any observations that you have on REITs and the general efficiency of the capital markets in India as it relates to real estate would be very welcome. So if you speak for about 10 minutes or so, then we can get into a discussion and a debate. I should also say to participants, I don't know if you've got the ability on your screen to ask questions, but I'm told that there is a online Q&A button. So if you can see it, and if you'd like to ask questions, please do, and I'll try and answer them, either get the panelists to answer them either while they're speaking or perhaps in a special session at the end. But let's see how we get on. Dave, the floor is yours.
Thanks everyone. I'm Dave Santani. It's a pleasure to be here today, and I'd love for this later on to be more participative and interact with some of the audience members as well. I've been with Brookfield for 7 years now, so I'm pretty much a veteran, because that's when we set up shop in India. For the first 2 to 4 years, and that's very typical of Brookfield as a firm, we did nothing in India, and that's because we thought, A, we needed to understand the market really well, and B, we wanted to make sure we get in with the right opportunity at the right time. And if that meant we did nothing for 2 or 3 years, we're perfectly fine with that with most markets that we enter into. Since then, we've scaled up our business significantly. So today we've got close to a AUM of $20 billion in the country. So we've got serious exposure in India, and it's a market which we really have conviction in and a long-term commitment to. And I think building off some of what Chan said, a lot of things that I agree with in his initial opening remarks. India is not for the faint-hearted, right? I think foreign investors, when they look at the market, need to look at it in both contexts. Is it a market where the demographics are right? Growth rates are really high? Yes. And can you make returns? Yes. And sometimes you can make really spectacular returns, including some of our investments, especially early on, which was far beyond what any of us actually anticipated in our underwriting. But having said that, it's a country where you need really, really strong local boots on the ground. And so I would definitely advise anybody watching, the worst thing a foreign investor can do when trying to enter India is do what I call the fly in and fly out model. Because I assure you, even if you are the smartest investor, even if you've done this in 5 other markets, you will fail if you do this in India. Like, unless you have boots on the ground and the right people sitting here monitoring your investments day in and day out, it's a market where you'll really struggle. It's a really, really diverse market. So you've got to know there are no generic trends across housing or office or retail or even warehousing, because each part of the country has so much micro dynamics for that region that you've got to be able to factor all of that in when you come up with your investment strategy. And I think it's a long-term market where you can see growth as long as you have realistic return expectations. So like Chan again said about the elusive alpha, I think if people come in with the theory that I make a X percentage in US dollars and then I'm taking an India risk, and so once I add an alpha for that, I should be making a 20% or a 25% US dollar return factoring the risk, I think at some point it becomes impossible to earn those kind of returns conservatively in any market. But as long as you have realistic return expectation, it's a market where you can make money as long as you get your timing and your underwriting right, which applies for most parts of the world. We are active in the residential space, we are active in office, and we've been looking at warehousing, retail. So it's the entire gamut, and of course we've got exposure in hospitality. So we've got exposure across the whole gamut of real estate. Talking specifically about REITs, Ravi, because you brought that up, we've got only three now active REITs in the country. It's a very, very critical part of the market which needed to develop and continues to be needed to develop. And we need to make sure retail investors get a good experience from it, because what's happening is all of the past 20 years of commercial real estate stock which was built was all capital stuck. And it's only now when private equities come in and when REITs come that some of that gets actually released, when retail investors buy into some of these REITs, and then that capital gets reinvested into fresh development. And that's really how the market can really grow. Yes, all the 3 initial REITs may not have earned a huge premium, but I think it's very, very crucial that none of them have lost value significantly despite what's happening in the COVID environment and offices not getting occupied, etc., as well as we would have all liked. And it's important, like I said, that retail investors see it as a very stable asset class so that it develops and we can have more liquidity for all the participants coming out of it. So I'll pause there and maybe we do more Q&A.
Yeah, that's terrific. I'm not getting much from the panelists in terms of Q&A, so let me try and anticipate the questions until some come through. You said something very interesting and quite revealing, Dave, which is that one must have, as you put it very well, when you're looking at an emerging market with currency risk, you have to factor in currency risk, and you have to factor in rupee risk. Now, when I was growing up, I remember, as maybe some of you do, but I'm older than you, the numbers 7 and 14. And 7 was the US dollar rate, and 14 was the sterling rate that we got in Mumbai. And of course, if you look at the numbers now, it's 62 or 70 and 100. And so, the Indian rupee, as global purchasing power parity will tell you, we have a high inflation rate, the rupee is going to decline. You add to that, of course, that this is an emerging market. There is governance risk. There's all of the attendant risk premia that you need to apply. You said that asking for a 20 to 25% return is greedy. What do you think is reasonable? What is sort of your hurdle rate for considering an investment in India? And that actually is a question for both of you. What do you think makes sense, and what do you think is achievable?
So look, I don't think we have a single target number because we are investing in many different opportunities across the risk curve. And as much as we've got to factor in, Forex and everything else concerned, it also has to be from the underlying risk. And sometimes the incremental risk I have to take to earn 200 basis points extra from that 16 to the 18 US dollar may just not be worth it for me, even if the numbers are working out. But I'd say broadly, you can sustainably achieve anywhere between 15 to 17 US dollar with a lot of hard work. And if you got everything right, which rarely happens as a combination, that could be achieved. But I think once you start looking at anything beyond 17 US dollar, you're really into the realms of risk where you're almost certain to blow up one of or more of your portfolio diverse investments, and your overall returns on your portfolio can't be what you wanted it to be.
Okay. So anything with a 2 handle is too high, but maybe with very careful work, you can aspire for maybe high teens returns.
High teens. Yes.
Yeah. Okay. Chan, do you share that perspective? Do you think those returns?
Yeah, absolutely. I think, for us, given the type of capital we represent, which is basically, school teachers and municipal workers and what have you, we are very clear we want predictability as opposed to trying to hit the ball out of the park. And so in that sense, I would much rather settle for a solid 13 or 14 than try and shoot for the 20.
Yeah.
Because that's where we've seen many an investment over the last decade falter because of the exponential risk that they've just referred to being taken either in terms of quality of partner or type of location or a combination thereof.
Okay, very good. And what about for both of you? I mean, Brookfield is US Canadian. Chan, Mumbai, Hyderabad, Delhi, Coimbatore are very far away from Montreal and the St. Lawrence River. What kind of additional risk premium do your colleagues in sitting at head office, are they happy with 13 or 14%? Do you have the mandate to do that, both of you? Is that okay? Or do you find that sometimes they can't be bothered for those sort of rates of return to take? There are lots of risks associated with India, right? Not least, it's a relatively immature market. It's not that liquid. You have, colorful promoters and local people to deal with, politicians to deal with. Is it enough for your constituents to say that, don't shoot for the lights because you're going to take too much risk? Be happy with sort of a, low double digits, teens to sort of a high teens rate. Is that message getting through?
Look, I think it's not an easy one, and I think thank God I don't get paid based on investments made just in India. We are totally aligned with global performance, and in that sense, therefore we are very selective about the kind of trades we would want to put our money into. But having said that, I think it's not easy to have conversations about Indian deals because, mind you, even in this vintage today, we look at the transactions in the City of London when I'm sitting on the investment committee alongside deals in Sydney, and obviously Indian deals post currency risk don't look as attractive, and I think those are factors that we grapple with. Hence, we are much more selective. Hence, I made the comment up front that our ambitions for India are much more modest, given some of those extraneous soft factors that you talked about that make investing much more complex.
Yeah, and I guess that also points to what you and Dave have both hinted at, which is that without a competent, capable local team, you can forget about it, right? This is not yet a market for the relatively passive investors to participate in. Okay, so I've had a couple of questions come in, which is great. So let's shift the focus to that. One questioner makes the point that, of course, India, as we know, famously has got half the per capita income of Brazil. It's still a relatively poor country. There are obviously pockets of great affluence, but in general, it's a very poor country with a great shortage of adequate housing. And I guess the question from a participant is, all of us these days are becoming more focused on ESG and on doing the right thing by large sections of population. What is happening in India with respect to providing affordable housing for the vast underserved segments? Are there government incentives in place? Is this a worthwhile thing to be doing? Because from an ESG perspective, obviously it's very good to provide low-income housing, but at the same time, it's got to make sense for investors. Is enough being done to encourage that sector? Is it a profitable sector to participate in? Will it achieve the targets that both of you have mentioned in terms of your hurdle rates for returns? That's a question from Michael in the audience. So let's try and tackle that one.
Yeah, maybe I can start off, Chan, and you can join in. No, that's a great question, Michael. So look, I'd separate housing into three segments to begin with, which is in our worldview, affordable, mid-market, and luxury. And these things mean different things in different cities, unfortunately. So what's affordable in Bombay is very different from affordable in different parts of other parts of India. But I would say excluding Bombay, broadly, mid-market housing is anywhere between $70,000 to $100,000 in that range, maybe $70,000 to $150,000. That's mid-market for us. Below $70,000 is definitely more in the affordable segment, and everything above that is luxury. All of this is ex-Bombay because Bombay works on just different economics altogether. Now, I think what we've discovered is mid-market housing is profitable. It's got a lot of demand. And as long as you get your product right and your execution right, it's a great market to be in. Luxury, I won't touch upon much, but luxury is the reason that the whole housing and the finance segment in India is having huge issues because it was overbuilt. There aren't enough people who can afford $1 million, $2 million, $3 million apartments. And because of the profitability involved, most of the developers in major cities focused on that segment instead of where the real demand was. Now coming to affordable, which is your sub $70,000 segment, the answer to your question is yes, the government does have incentives. So it's got two sets of incentives. One, for buyers, the government provides an interest subsidy. So home mortgage rates in India are fairly high, and they get on a base rate of maybe 8%, they get a 3 to 4% subsidy. So their borrowing cost is half of what it otherwise would be. And developers putting up these projects get complete tax exemption. So the government is doing its best. They have a couple of schemes to really encourage this segment on housing. It is a great segment from a demand perspective. It's not always necessarily investor friendly for two reasons, like from our perspective. One, it doesn't necessarily add up from size perspective. So one of the things we really struggle in at Brookfield is we are investing out of large global funds. The segment that I head for India is called BSI, Brookfield Special Investments, which is a $4 billion fund. And it's not easy to go do like a $50 million or a $70 million investment because, from a global fund perspective, some of these sizes don't make sense. What my personal view on affordable, like it carries, because the margins are so thin, right? One of the risks it really carries is the difference between your all-in landed cost and your sales price is really low, and it's really a volume and execution game. And India, every few years, has a huge inflation cycle. And all it's going to take is one cycle where steel, cement prices go off the charts, which incidentally, they already are in COVID times, for you to get completely wiped out on the margin. And it's just one of the really key risks on that segment, other than the fact that your customers are people who are not necessarily having a regular source of income. And so the customer payment profile is also very, very sketchy. So while the positive is there's a lot of demand, I think it's a segment which carries a lot of risk, both from a customer payment perspective and from a inflation risk perspective.
Yeah, absolutely. I think Dave has articulated and summarized extremely well. And I'll just say this, that, housing is obviously 70 or 75% of the overall real estate marketplace in India in terms of investable volume, but it's highly fragmented. What you describe as affordable, I may describe as social housing. And we have to be very clear, and I'm not shy of saying that we are commercial investors. We are not an NGO. Our capital has a certain cost, commercial cost, and as a result, for the reasons that Dave has already mentioned, not least a inflation trend that is somewhat perennial in this market. You have to be very careful what type of product you're investing in as far as housing is concerned. And so to our, based on our experience, both at a personal level and as an organization, we've taken the view of not trying to participate in small projects, for sale residential projects, rather focus on things that have scale. And to that extent, for better or for worse, we have taken the call of participating in a large township outside a large metro area like Mumbai, because we see that as a natural latent demand factor, where there is a natural urbanization process which benefits the partner. And latterly, we've chosen to participate in the public issuance of shares of the same partner, because we see that as a potential of piggybacking and making sense in terms of scale and their ability to actually go out there and build economies of scale, and we benefiting as investors from that. And therefore, to Dave's point, as global institutional investors, we find it very difficult to write these $20, $30 million checks. Rather, we'd like to do maybe $100, $150 million with a single sponsor, diversified, and trying to make sense of different pockets of the overall residential market, if that makes sense.
I think we lost Ravi.
Yeah.
So there's a question, Chan, which maybe while we have everybody on, maybe you can start on that response, which talks about the logistics market in India, that it's swiftly growing, and what's the return expectation on that. So maybe you want to lead with.
Yeah, sure. So look, the logistics market is still very nascent relative to, let's say, China, which is about, let's say, 15 years ahead in its evolution cycle. But having said that, I think the big trigger as far as India was concerned was the unified goods and services tax, nationwide, that came into being in the summer of 2016, and that has changed the contours of the marketplace completely on a national level. And the antiquated local octroi laws, all of that, have basically been done away with, and that is extremely attractive. It's more like an economic union of the entire country, which was not the case earlier. And we find that, again, very attractive from a scale perspective. Having said that, I think this is it's still very, very nascent. The overall stock of grade A warehousing space is still at a fraction of what it would be in OECD markets. But we see that as an opportunity to grow from a low base. We've had some success as a firm in China, for example, where we're investing with the same partner, and we've seen them grow multifold over the last 5 or 7 years. And we see the same sort of dynamics playing out in India, especially alongside the GST. The other trigger has been the rapid digitalization of the economy, primarily because of the unified biometric code nationally, and just a general digital push. So our belief is that India is sitting on the cusp of a digital super cycle. There've been a number of investments in the private equity space over the last 12 months that have been well documented in the digital space. We see all of those as a culmination to recognizing India as a potential marketplace for the online or e-commerce space expanding. And we are basically looking at that as area as one of the potential growth areas. The biggest challenge that we find is the relative inelasticity of rents and the monopolistic tendency of the large 3PL and e-commerce buyers of space. And that is obviously a dampener in the short term. But we are again looking at this, in a block of 10 years. And we think that over the next 3 or 4 years post the pandemic, we're already seeing the trends deepening with e-commerce buying becoming much more rooted. But it's still, the formal e-commerce sector is only 3 or 4% of the overall retail commerce. So it's many years to go before we really build a certain scale, and we find that attractive. So we're basically participating in a measured manner, if I can call it that way.
Yeah, that's terrific. Sorry, I had a catastrophic internet failure. It seems to happen more often in London than it happens to me in Mumbai, actually, which is a bit worrying. So look, to the panelists or to the participants, I'm sorry to have to tell you that apart from Amit Khanna's question, which is up, I've lost the previous two. I managed to answer Michael. So if you wouldn't mind typing it in again into the Q&A chat, that would be great. So we're going to shift focus, I think, from the specifics of sectors to talk about the regulatory framework. We talked a bit about the insolvency code and how it's had an effect on banks and their credit recovery. But I've been told that it doesn't really apply to real estate, and that it's still not good enough to enable somebody to get proper recovery out of an insolvency. So that's the first question. And then related to that, do you see merit in, this is a direct question from Amit Khanna, do you see merit in lobbying for transparency, consistent regulation in the real estate market? It's very difficult to deal with a constantly shifting regulatory landscape. What can we do to get more regulatory stability, transparency, and to get it to be more orderly? Do you guys spend any time doing that? Because clearly the environment will drive what you can achieve. Yeah, maybe we'll start with you, Dev.
Yeah. So look, on the IBC, just my 2 bits on, firstly on overarching, I think it's a fantastic regulation. I think it's been implemented very, very efficiently, and the whole structure, what we have today versus 3 years back, from a lender perspective, there's a sea change. And I can tell you, I've been doing this for a long time. I mean, today, your ability to sit across a counterparty or a promoter of a company, and his real fear that you are going to take him to bankruptcy, he might lose his company, you'll basically create a storm of claims from all his other lenders, and the problems you can create for him. There is a genuine threat today versus 5 years back, when the guy would just lean back and say, yeah, sure, like, you want to sue me in court, like, good luck, like, I'll see you in 10 years. So I think IBC's has made a sea change. And yeah, you will have people complain about, oh, it's not as fast as it should have been. Oh, it didn't cover for XYZ scenarios. Oh, it's too complicated. But look, the reality is it's a difficult legislation. We've got tons and tons of cases from a value and volume perspective. So obviously the system is struggling through some of the timelines which they committed to. But the recoveries have been excellent. They've got close to 40-46% recoveries on things that have passed through IBCs. A lot of settlements are actually happening pre-IBC, which the data doesn't capture. So I think all in all, it's got work to do, but it's very much a step in the right direction. Now on housing, I don't think the intent was wrong. I think they've implemented something called RERA, Real Estate Regulation Act, which is meant to protect the interest of the customers, and they implemented IBC. And collectively, it's looking out for interests of the buyer. So I don't think the intent is wrong. I think the biggest confusion that's happening is in India, a lot of pre-sales are done where the buyers are paying an initial upfront deposit and then paying installments as the project gets developed, right? And that makes the customer almost a lender to the project, right? Because he's paid for maybe half an apartment at this point, and the project owes him money if it doesn't get completed. And when something goes wrong and a project is getting defaulted, I think there's a fundamental disconnect on, does the project belong to the lender who's lent to the project, or an investor like us who might have done it in debt form or an NCD form, or does it belong to the customer who is also lent to the project in some form because he's put some capital down and that's been used for the construction. And there's a lot of ambiguity about you being able to take over a project. You need customer consent, and what happens if it's a large project with like 1,000 customers? How do you go around running around taking their consent? So while cases have happened and there have been successful takeovers and handovers to new developers by investors, so it's not like the system's not working, but it's not as straightforward as we would have liked.
And do you have any observations on that?
Yeah, I think the biggest achievement of the IBC is acting as a deterrent. Putting people on notice or rogue promoters on notice, and I think that's its biggest achievement. Dave has already articulated the aspect around housing, so I won't repeat.
Yeah, no, terrific. Okay, so we've got obviously a series of attendees that are from the business school, so they are quite focused on the practical implications of all of this. So if I can just summarize what you guys have said and then press you for some more granularity. I think you're both saying that if you have realistic return expectations, if you are very organized with respect to execution, if you spend some time to navigate the political and regulatory framework, then you can indeed make a very desirable return in India. So I think we've established that, notwithstanding all of the challenges that are coming from, the media on COVID, etc., that if you are prepared to do all of those things, then it is still possible to generate good alpha in India. Okay, so that's good news. Now, just to press you a bit, because as I said, these are business school students, and it would be remiss of me not to ask you, can you just identify one or two of your favorite either investment ideas, projects, themes, sectors? I leave it open to you. If you were putting money into India today, where would you do it? Geography, sector, and any other observations on the evolving investment landscape would be very, very welcome. Maybe we start with you, Chan, on this occasion.
Yeah, look, I think it's a pretty simple sort of model. I mean, our convictions, as I said, remain around the concept of office, and basically with the underpinning of technology. Mm-hmm. So not so much city center CBD type office that you would see in Canary Wharf, but a more suburban technology, addressing the technology markets. It could be life sciences, it could be pure technology. And I think that really is something that we've hung our hat on. Recently, we just announced a build to core venture with a leading Indian developer with a focus on Bangalore. To do office, and the thesis there is very simple. We think that Bangalore, data confirms that Bangalore is one of the most innovative cities globally today, notwithstanding its creaking infrastructure. It has one of the most robust startup systems in the world, and it has a list of occupiers, corporate occupiers in the technology space. That's a who's who in the global technology space. And this is a partner that we've chosen to do it with, who launched the first REIT with Blackstone last year. Have done 40 plus million square feet of development in that marketplace. And I think that would be an example of how I look at India. Don't try and be esoteric for the sake of being so. Just try and focus on the basics, trying to do things that have been successful. So to our mind, if Bangalore fails as far as office is concerned, then India office doesn't exist. That's the way we look at it. And I think some of those types of ideas is what I would recommend for folks looking at India as an investment destination. Obviously, you know, Brookfield has taken a much bigger exposure to the country, and you know, good for them. And I think it's also linked to vintages that you have capital to invest in. And I think, and to Brookfield's credit, they were able to see an opportunity between 2013 to 15 when there was a extreme dislocation of capital in the marketplace, and made their moves. So I think it's about getting your basics right is what I would say. That would be very important in markets like India, and not try and ape others, but have your own convictions and do the small things well.
Okay, terrific. So just to play that back, so commercial real estate, specifically offices, not the old style of CBD offices, but maybe technology-enabled clusters for particular sectors, or where you would go, Chan. Okay, that's really very, very interesting. So I guess there is a question here about are CBDs still attractive? And I guess you're saying maybe, but you'd rather be in these new tech-enabled clusters.
I think post-COVID, some of these CBD clusters are going to be hugely challenged. Right. That's my prediction.
That's interesting. So that's food for thought for the next panel, which is discussing the future of the office. Dave, what's your perspective on the most attractive sectors or geographies right now?
So look, we've been looking at everything across the gamut, from resi to office to retail to warehousing and hotels, right? And our general worldview at Brookfield especially is, I don't think we tend to say, oh, I want to do offices this year, or I'm hugely bullish on a particular segment, because it's very, very opportunistic on what kind of, I don't think we set out, for example, to say, oh, I want to do a huge investment in hotels last year. But then we saw something which was really attractive, and we thought it made a lot of sense from a value perspective, and we went ahead and did it. But if I had to make a bet on, you know, both in terms of scale and long-term returns, I would probably say from a conviction perspective, it's office and residential, both, which are both large sizes of the markets. And as long as you do sensible underwriting, they are here to stay.
Yeah.
Everything else around retail, warehousing, hotels has more cyclical element or a lot of early stage development risk, versus I think you can do a much more balanced and large scale play with both office and resi.
Yeah, which segment of resi, Dave?
Probably more focused on mid-market. Like I said, affordable, we don't necessarily see huge allocations to. And I don't think luxury is a bad word as much as it's been made out to be. I mean, at the right value and in the right locations, you know, occasionally luxury makes sense. We made money off investments in the luxury space as well.
Yeah. So just because you're from Brookfield, and you may not know the answer to this, but you know, there was a very well publicized acquisition of a company called General Growth Properties that Brookfield made in the US, which was as you know, a retail mall, which was some indication of you know, confidence in that sector. Do you think that retail is under severe challenge in the UK, right? Particularly after COVID and online shopping. Generally, do you think that these malls that have sprung up all over India are going to continue, or is that not a profitable place to invest right now? Quick answer to that, and then I'm going to press you both on another sector that's quite interesting in the UK, which doesn't seem to exist in India. So just let me have your views on retail then, Dave.
So retail, I think we struggle with 2 or 3 things. One, we need large platforms. So it's not our strategy to go and collect like individual malls.
Yeah,
right. It's more, we want the right kind of platform, which we aren't seeing. And B, the problem with retail in India is they are developed in oversupply clusters. So it's just, you see clusters of developments where there is too much supply and then nothing where it should be.
Yeah.
So we haven't really done anything of scale there so far.
Right. Okay. Finally, a sector that doesn't really seem to exist in India, and let me preface my remarks by saying that you know, if you're a young Mancunian, if you're born and brought up in Manchester, and you want to go and study in Birmingham, for example, increasingly you find dedicated student housing. Oxford and Cambridge, Oxford, where we are speaking, and Cambridge, which I know pretty well, are exempt from this because the universities have got plenty of housing. But if you're a young chap from Rajasthan who wants to go to Calcutta to study at Presidency College, it's going to be difficult for you to find a place to stay. You're kind of at the mercy of the private market or having a relative or somebody who will let you in. Why is student housing so underdeveloped in India? And is it likely to be an interesting place to invest going forward? What's going on in that sector? I think given that we've got some students in the audience, it's worth talking a bit about that. And any of you?
Yeah, okay, I'll take it. So look, I think it's certainly interesting. I mean, India is a young country, country of millennials and Gen Zs, and we have looked at a couple of transactions right now. The space is very, very nascent. It's basically fit for venture capital type investing, more funding aggregators of disparate strata title units being strung together as an aggregated product. The only example that we saw was, I think, mid last year when Goldman backed a purpose-built student accommodation on site, which is not usual in developed markets, from my understanding. And they basically had a platform of about 20,000 beds and looking to expand that, where one of the minority shareholders was exiting. We looked at that transaction. We liked it. We found it interesting. Some existing product, some new build, and I think it was. We also think that Indian parents are generally looking to keep their children closer to home and are, have better resources to pay for their accommodation closer to what they're used to at home. And hence, we have seen that tendency growing. But, one of the things that it's very nascent. Like I said, we'd like to see this become more institutional. It's still Series A, Series B type of funding. The second thing is a lot of these private universities, Ravi, are funded or by politically exposed individuals. And that's something that we find somewhat uncomfortable, to put it mildly, for association purposes. And hence, we think that the federal government has made certain pronouncements in the recent past about allowing foreign universities to come in and set up campus, etc. Yeah. So we think that this is about maybe 5 years or more away for an institutional investor like us really participating. I mean, recently we bid on a portfolio in Australia, for example, that went to one of our peers. And we see those type of opportunities much more scaled and much more first world. And so, our focus would be trying to take something like that down, then try and focus on, local opportunities at the moment.
Right. So too early for student housing in India. I guess you share that perspective there.
Yeah, I agree. It's very nascent. A lot of political exposure, like Chan said, and a lot of critical large universities. The housing is actually controlled by the university, and there's not really much of an ecosystem around. And India, because it's a cost-conscious market, given a choice between an organized student housing play where you end up paying higher for facilities versus going for a PG kind of accommodation, which is much cheaper, I think the sense is also for a lot of these universities, people might just go for the cheaper option. So it's a combination of all of those things, not enough scale.
Okay, so a bit early. Okay, final question from me before we wrap up. This is not so relevant for you, Chan, because clearly funds are allocated to India as part of a global asset allocation process, I assume. But Dave, how does it work for you? Are there dedicated India funds that you sell to international investors, or do you too get allocations from global funds with depending on the view towards India? How does that work? Which is better to do? What do you think the market for dedicated Indian PE funds is overseas? Do you have any sense for that?
Yeah, so Brookfield globally has only, our philosophy is we only have global funds. So we don't
Right.
have any country specific funds anywhere in the world.
Yes.
So that's how it applies for BSI as well. We've raised a global fund, and you've got to fight for allocation. There's no pre-agreed allocation other than, things like you would say only 40% of the fund would go into emerging markets, like those kind of limits.
Yes.
Rather than that, you've got to compete both from a capital allocation and a returns perspective with the China, with the Brazil, with the Middle East, all the emerging markets. And the allocations are, I mean, I would say the way it works is internally, there's obviously a thought process saying like, hey, like this is our fund size, we want to put this much capital in India. But none of that is cast in stone. And I think the advantage is it gives us a lot of flexibility, because if I raised an India specific fund and then the cycle went the other way and I didn't find any right opportunities, now I've got to return capital back to investors. I think it makes sense to have a global strategy where you can move capital between different geographies that we are present in, depending on where we see the right kind of opportunities.
Yeah, terrific. So let me press you, and you may not wish to answer this, but both of you, what percentage of global real estate funds are allocated to India? So you clearly have a global remit. How much ends up getting allocated to India? And do you see that growing, shrinking? Your observations on that, and then we should wrap up. We've got a couple of minutes. I'll give you a minute each to answer that question if you'd like to.
We don't have any India specific allocation. It's one global balance sheet. And the best investment opportunity gets it.
Yeah.
We have modest aspirations for India in the short term, and it'll grow over a period of time. We don't really have any specific percentages.
Yeah, what's the number right now, do you think, allocated to India out of your global funds, if you can tell us?
Well, maybe a couple of percent.
Right. Okay. Which is pretty small. What about you, Dave? What percentage of Brookfield's global funds are allocated to India?
Again, similar philosophy. I don't think there is any hard number there. So the only number there is 30 to 40% of the total fund can go to emerging markets, depending on if the IC feels is the right allocation. But other than that, there's no real firm number.
Right. But where does it land, for example? I mean, if you were to look at the global scope of funds that you have, where is India?
I know. I mean, if you looked at it that way, India is a 20 billion AUM today on our total AUM of close to 600 billion. So that's where we land at an overall market level. But then, that 600 billion was built over 30 years or whatever. And, this 20 billion is 5 years. So it's not really the correct perspective.
So I guess the point is that as a percentage of global capital dedicated to real estate, the percentage allocated to India is still relatively small, and it is likely to grow. I think that's a pretty safe assumption on which to end. Okay, well, listen, guys, you've been a very terrific pair of panelists. It's been a real pleasure to talk to you. I'm sure it's been extremely illuminating for the students. I've learned an awful lot from both of you, so I'd welcome the opportunity to continue the conversation. If you're ever in London, please do look me up, and I'll try and do the same in Mumbai. Thank you very much for being terrific speakers today. Much appreciated.
Thank you, Ravi. Thank you.
Yeah, thanks. I think we're going to wrap it up there, Darius. Thank you very much.
Thanks, everyone.
Bye-bye.